So, in this chapter, we are going to talk about the stock market primarily, and then we'll just kind of talk about its cyclical fashion, where the most obvious ones we see are when we talk about there being crashes. For those of you who know me, who've had me for other courses and know me pretty well, you would know that I do a lot of work, both research and just general interest in the stock market. I don't know if I wasn't a professor, I'd probably be um, stuck on Wall Street in one form or another. Um, and what we're going to do in this chapter is just talk about what the stock market is, the role that it serves, and just kind of try to explain that a little bit more for those of you who really don't have any knowledge at all about it. For those of you who do have some knowledge about it, this might seem a little boring and a little bit elementary, but bear with me. So, what is a stock? We'll just kind of start with that very basic definition. So, a stock is basically a share of ownership. Um, a typical company has typically issued hundreds of millions of shares, and you can buy those shares. And the company issues those shares of ownership initially in what's called an IPO, which is an initial public offering. If you're not buying the shares at the initial public offering, then basically you are buying the shares that someone else has sold. So it's kind of like a resale market. Um, Most trading, almost all trading that occurs is basically the reselling of a share that someone once owned. So there needs to be both buyers and sellers in the market for the transactions to occur. When there are more buyers than sellers, the prices tend to be bid upwards. And when there are more sellers than buyers, the shares tend to be downward placed in price. The shares give you a right to vote for the board of directors. They also allow you to earn a dividend, which is basically money for owning a certain number of shares. And if this company should ever be sold to someone else, you will then get money per share that you own. Now, there's entire courses on this slide. In fact, some of you have taken the class already with me. That would be BUSA 311. So, the BUSA 311 course that I'm teaching this semester is all about determining why stocks are priced the way that they are. A large part of why they're priced a certain way deals with the fundamentals. The fundamentals meaning what is the stock, what is the company projected to earn in the future, and what are interest rates expected to be in the future. And by making a bet on what we think these things are, um, we calculate what the share price ought to be. And then part of it is non fundamentals. Basically, how do we feel about the stock, right? Does it have a good product line coming out? How well is the management at running the company? So, both the fundamentals and the non fundamental, basically non quantitative things, how do these determine the share price together? And so, when we go back to the fundamentals, again, the quantitativeness, we basically are trying to predict what the earnings are going to be in the future, and then we take the present value of those earnings that are going to be earned in the future. And if we think that earnings are going to keep going up, then the stock value is going to increase. If, on the other hand, we think that the earnings are not going to increase that dramatically, then the stock value is going to be hurt. Um, And then interest rates affect things, especially if the company has a lot of debt on its balance sheet. And if interest rates fall, it becomes easier to manage that debt, which would also tend to increase the stock value. As I already said, the role of the stock market is to serve as a marketplace, basically, where these companies can issue what's called the IPO, the initial public offering. It's when the money, it's when the stock is sold for the very first time. The money that is paid for that stock goes to the company. The company does not get any money when the shares are resold. They only are getting the money during the initial public offering. So they need to get as much money as possible during that initial public offering. And that's kind of our second bullet point here. Most sales of stock, like 99% sales of stock, do not involve the company either receiving or paying money. It's simply someone, an individual selling it and another one buying it. The only time where the company could possibly make some money is if they did what's called a share buyback, where they buy back some of their shares, which they could then sell again in the future. Um, Generally, if a company is buying back its shares, it must believe that it's going to do really well in the future. So it's generally a vote of confidence in the company. Um, Before a company gets to the IPO stage, it generally there'll be some sort of place where those stocks, or not stocks, where those securities can trade. So there is a non IPO market. Um, if you've taken other classes with me, we've talked about it, but let's just look at a few of these. The big one would be Crunchbase. I'll look at these. I obviously don't have a subscription, so I'm not going to be able to look at too much here. But if you've watched any episodes of Shark Tank, you kind of see what's going on here. They have what are called funding rounds, where basically companies come out and venture capital firms come and provide money to a company that hasn't received an IPO yet, and provides it some money in return for having some greater shares of ownership. Um, I see. It's going to be hard to find any companies that we've even heard of, because what we saw in 2021 and 2020 was a lot of companies that had not had an IPO yet. All, yeah. I mean, just I haven't. I know a lot of companies out there, and I haven't heard of any of these, and that's saying quite a bit. I don't even know what the. And the reason why I'm not seeing very many is because even this is not going to show this kind of event that's been happening. But um, companies that weren't ready to have an IPO yet and didn't want to go through that process, instead of doing an IPO, they did what was called a SPAC. So, what a SPAC is, SPAC, is a special purpose acquisition company. And basically, you're forming a company, getting a ticker symbol, which is basically the way you look up the company, and then that SPAC uses the money to buy a company and kind of make it a stock. Um, Probably the best example we have of um, a SPAC would be WeWork. I think is a SPAC. Yeah. So this was kind of a famous example of a company. WeWork was kind of a shared office space company, and then it almost did an IPO, but then the IPO kind of collapsed, and then COVID happened, and WeWork wasn't probably going to be able to get an IPO. But then another company emerged that formed a SPAC, and that SPAC bought WeWork. So here we go. So uh, the what's called the blank check firm. So Bowex Acquisition Company, BOWX, basically took the money and bought WeWork, and then WeWork basically took over um, the um, the space. Um, yeah, so SPACs comprise a group of large investors that come together to help a company speed up its public listing, often at the expense of transparency. I'm not a big fan of SPACs. Let's talk about what you get when you get an IPO. So I just bought I bought into an IPO about 2 or 3 months ago. It's called Backblaze. Backblaze does data storage, cloud-based data storage. Um, and when it did its IPO, yeah, back in November, um, what you get is you get the financials about the company. You get the balance sheet, you get cash statements, cash flow statements. You basically get all the information you would want to better understand the company before it has its IPO. And then people buy the IPO based on their assessment of those documents. A SPAC, you don't have to do that because the company like WeWork doesn't have an IPO then. It's that other company, that Boex acquisition company, that has all this kind of big money in there that then bought out WeWork. And then WeWork is the ticker symbol then. It doesn't have to have an IPO. Um, you'll lose a lot. Um, and the problem that we're seeing right now in 2022 is that the companies that went public via a SPAC have lost a lot of money. Let's look. It's now 650 a share, but that's down from when it was 923 a share. And if we go out to the max, it was $13 a share when it finally went public back in October. And now you can get it for less, for about half that. It's losing money. So earnings per share, it's actually losing money here. Um, in terms of what's the company valued at? The company right now is valued at about $5 billion. If you saw that Wikipedia entry I looked at, it was valuing it at $9 billion, and now it is worth $5 billion, so about half. Let's look at some more of the data here. I don't care about that stuff. Let's just see how many shares are issued. Shares outstanding. So there's about 800 million shares outstanding. And I can see that the firm earned about $2.6 billion in revenue. Um, and that basically, again, it lost money on an EBITDA basis. It's got money going out. It doesn't have a positive cash flow. It has cash going out. And it does not pay a dividend. Um, what the trading does of these stocks over time, what it does is it ensures that the riskier nature of some stocks, that's reflected in their share price. If you're willing to take on that risk, so in this case, WeWork is deemed pretty risky because it's lost half its value. So everyone's expecting it to continue falling and it to become an even less valuable company. If something happens where all of a sudden it I don't know, some big transaction happens and WeWork all of a sudden starts to do successful, then the share price would go up. But I'm not expecting it to happen anytime soon. Now, in general, um, the belief, for the most part, would be that markets are efficient. That basically there's all this information out there, so you can watch something like Bloomberg, you can watch something like CNBC, and you can get all the data you need. And so there's this related to the fact that the market is efficient. The efficient market hypothesis would basically say that all the prices are in general pretty accurate. For anyone who's not taking my BUSA 311 course, um, you can kind of see this. Where do I get most of my data from? Just in case you're curious, I get most of my data from Koifin. Um, and you can logins are free; you don't have to pay anything for it. But what I like is that I get all of the data that I need, so that I can then kind of make the choices that I need to make. I can create analytics and whatnot for different companies. If this kind of topic really interests you, I'd really strongly encourage you to take the BUSA 311 course. Okay. So, what where we see these markets, where we see them operating, is these stocks are generally listed on indexes, and the indexes you've probably heard about already, just because they're pretty popular. So that'd be things like the Dow Jones, Standard and Poor's, or S&P, and Nasdaq. And generally speaking, if you listen to any business program, they'll generally tell you what those weighted averages are. But for something like um, Dow Jones and Nasdaq, they're generally dominated by just a few of the biggest companies, and those few big companies um, really give you an idea of what, or they're going to just generally greatly affect what the value is going to be. Um, the index value is going to be. And you see this kind of here, where the Dow Jones level is increasing over time, and S&P and Nasdaq. So all the general stock market indexes are going up. Now, many of you have heard of the large examples of companies that have, or times when the stock market has crashed. So the famous example would be something like October of 29, when the stock market lost 25% of its value. Um, and then the other would be October of 87, when it lost 20% of its value. Actually, for the October of 87, we can actually. Actually, I think it was a Tuesday. Sorry, I don't think it was Black Friday. I think it was Black Tuesday. Black meaning, um, the stock market lost a lot of money. So we say into the black or into the red, um, or sorry, Black Monday. I'm not going to listen to 30 minutes. Hmm. Yeah, watch this part. I've never seen this.
The nightly business report, made possible by Digital Equipment Corporation.
So this is from PBS. The Nightly Business Report is a PBS program that you can still watch if you're interested in that kind of stuff.
With its new generation of VAX family computers, connecting headquarters, branch offices, production, and research centers into a single integrated computing environment. Digital has it now. By Kidder Peabody. For over 120 years, one of the world's leading investment firms, serving the financial needs of individuals, corporations, and governments. Kidder Peabody. Professionalism worldwide. And public television stations across the nation.
What about viewers like me? No, I didn't say that. Oh, look at those old computers.
Good evening, everyone. Well, the law of gravity hit Wall Street today, and financial markets around the world, for that matter, as stock prices plunged even more than they did on Black Tuesday of 1929. When the dust settled, the Dow Jones Industrial Average had lost more than 508 points on volume of 604 million shares. That's nearly double the previous record. We have reports on the impact of the crash from New York, London, Washington, and Chicago.
Suddenly, it was a free fall, a better than 22% tumult in the Dow, and nervous traders were looking over their shoulders, back some 58 years ago this month, remembering a little overacted movie that seemed to hit home today.
Confusion spreads through the canyons of New York City's financial district, and men stare wild-eyed at the spectacle of complete ruin. More than 16.5 billion shares change hands in a single day of frenzied selling. The paper fortunes built up over the past few years crumble into nothing before this disaster, which is to touch every man, woman, and child in America.
So that right there is ticker tape. So when you hear of a ticker tape parade, it's that tape that was coming out. That was basically using telegrams, basically, or Morse code to telegraph lines to communicate what the share prices were going to be.
To a degree, it might not be as severe as we had in the recession and depression of the 30s when it was more of a worldwide phenomenon. But it could happen again.
Well, there weren't exactly people flinging themselves off buildings, at least not that we could see today, but there were a near record number of people gathering outside the New York Stock Exchange today to sort of witness history in the making and the opportunity to see incredible drops in the Dow right before their eyes.
I want to see what it looks like when it's in this condition. And then I wanted to see this stock market anyway.
We want to see a piece of the action, I guess, at Wall Street.
What they saw was programmed selling taken to the ultimate art form, as Wall Street's very biggest players stepped in and unloaded multi-billion-dollar blocks of shares, much of it fueled by mutual funds, hard hit by individuals pulling their money.
So just so that we understand here, if you're not buying individual shares of stock, many of you probably do own stock indirectly, and the way that you indirectly own it is through mutual funds. Mutual funds are basically an investment where it owns a variety, a diverse pool of stocks around a kind of a common goal.
Out. And what would normally be a 50-point decline becomes a 100-point decline, and a 75-point decline becomes a 200-point decline.
The panic selling got an unlikely boost from Treasury Secretary James Baker, who tried to stop last week's bloodbath by suggesting over the weekend that the dollar needed to decline more. But that only opened old currency wounds, the same wounds the bond market has been licking for months now.
What has happened in the bond market is now being played out in the stock market, and I think it has more to go.
I think stock market ignored what was happening in the bond market for a long time until suddenly woke up to it in the last 2 weeks or so.
But for many brokerage houses, the pandemonium was eerily quiet, as traders were reduced to quotron watching and what little they could get from knowing that in Tokyo and in London as well, the story was the same. Everyone was getting hit. To the end, market analysts are steadfastly refusing to even mention that word crash to describe what's going on right now. Instead, they like to look at it as a correction that still has to work itself out. But what they don't know, and in fact readily worry about, is how far down that correction really has to go, how long it will take, and exactly how many more people will be hurt in the process before the market does decide, if it decides, to turn around. In New York, Neil Cavuto for the Nightly Business Report.
This is Shelley Carabell in London, where the reaction was especially bad because the exchange here was closed Friday due to storm-related power cuts. The FT 100 index lost more than 150 points in the first 2.5 hours of trading, then plunged to 302.1 points down when Wall Street opened. London stayed open an extra hour in an attempt to recover, but when the closing bell sounded, the index stood at 2052.3, down a whopping 249.6 points. In Paris, the Bourse indicator fell by 10.36%. Food companies which export to North America were especially hard hit. In Frankfurt, West German stock prices posted their largest losses ever. The Commerzbank index tumbled a record 132.5 points to close at 1876.6. Earlier in the day, Tokyo's Nikkei average lost 620 yen in its sixth largest fall on record. Dealers blame the worldwide decline on the sharp drop in the dollar and fears of higher interest rates. All the money that drained from stock markets went into gold, which closed in London at a 6-month high of $485 an ounce, up $19. In London, I'm Shelley Carabell for the Nightly Business Report.
This is Scott Kirby in Chicago, where today traders were using words previously forbidden: panic, crash, free fall, meltdown. They just put their hands in their pockets and stared in disbelief as the Standard & Poor's 500 future fell and fell and fell. People are
don't need to keep watching this here, but you get this basically this sense that the stock market fell quite a bit, and there's a little bit of fear and there's a little bit of panic kind of in the air when they're all talking about this, and you kind of see that in just kind of the way that everyone's talking is that stock markets can get a little bit concerning. Okay, let's go back to this. So generally speaking, we get in financial markets as a whole, we get bubbles. In fact, I've taught an entire course on financial market bubbles. I taught it at UH Manoa last summer. If you're interested in the lectures, I'm happy to share them with you. Just let me know. But the most classic example we have of a bubble is the Dutch tulip market. And I want to show you a kind of a funny commercial that helps explain it. Obviously, I know how to spell it. I just typed it in quickly. So this commercial explains it well. I'm going to pause it every now and then just so to kind of explain it here, but it's not that long.
Planned by Google. Save big on the new Samsung Galaxy S22 series.
Let's skip the ad. Okay, so here we're in the Netherlands. It's like the 1600s, and these tulips are going to be traded. 1636, the Netherlands.
How much for those? For the tulips? They're 1 guilder each.
1 guilder. Okay, so the Dutch guilder is one of the world's oldest currencies. It doesn't exist anymore. It's been replaced by the euro. But that guy, that fancy guy there, is going to buy some tulips for 1 guilder.
He took all of them at double the price. I made a fortune.
Okay. Now, that guy is just saying, dude, I sold all my tulips. I made so much money. And the other guy, the guy right here, heard that and he's like, that guy is dumb as bricks. This guy's dumb as bricks. I could make so much more money selling tulips.
Tulips.
3 guilders, 5 guilders, 20 guilders, 40 guilders. Those right there are tulip bulbs that are selling. 60. 75.
We will start this bidding at 100 guilders, looking for
So there we go. We keep seeing the price get bid up and up and up, and everyone has this fear that if they don't buy it, um, the price is just going to keep going up. So everyone's kind of rushing into this market. We see bubbles like this all the time, right? The housing market, we see that. Certain stocks, we see those kinds of bubbles.
240, 260, 500. Ladies and gentlemen, we start the bidding at 1,000 guilders.
1,000 guilder, from 1 guilder to 1,000 guilder.
6,000. Okay, 6,000. I'll meet you at my house. Sold.
This is pretty accurate. Um, the um, the tulips were selling for the price of houses at its peak.
Excuse me. Why is a tulip worth so much? It's a tulip. Please don't stay.
And there we go. There's our bubble bursting, right? That there begins to be a realization of, dude, this is just a damn tulip.
Please, 5 guilders for your wife.
Tulip prices. It's rock bottom.
Stupid tulip. Market frenzies. If only they had Cambridge, they could have balanced risk with a straightforward high-rate annuity. As long as there's market uncertainty, there's Cambridge.
Okay, so these bubbles, we see them in the other kind of classic example we have would be the internet stock bubble, which would have been around the time that many of you were born, so you wouldn't really know. But basically, if you were an internet company, the most famous example being Pets.com, which had this kind of actually looks like they got bought out. And you could watch a whole video about it. But basically, Pets.com was a internet stock, and basically, as the internet kind of came into form in the late '90s, early 2000s, anything that had a web address, that company became pretty valuable. And so this one, Pets.com, was about selling stuff for pets through the mail, and most and that was kind of the cause of the 2001 2002 recession, was the bursting of the dot-com bubble. But what is kind of a bubble? It's basically when things are valued at prices far beyond their true intrinsic value. And that's what we kind of see here. The one being the Asian financial crisis of 98, 99. That would be when different currencies, primarily in East Asia, Malaysia, Thailand, South Korea, those currencies fell drastically in value, causing those countries' economies to collapse. Then you've got the dot-com bubble. That's our NASDAQ here, where the NASDAQ as an index fell, in this case, 50% in a year. And you see that kind of here. It doesn't recover that level of over 5,000 for almost 2 decades. Sorry, a decade and a half. And that basically, just kind of like how we saw in the commercial, what happened is that basically investors at some point realized that internet stock companies can't just keep getting losses forever. At some point, they need to make money. And then really kind of what drives it, just kind of like how it did with the housing market, is that interest rates started to rise. See, what was happening, and this is when I was at the Federal Reserve, what was happening is that in the lead up, I started at the Federal Reserve in 1999. And the big concern, which some of you probably don't remember this, well, you wouldn't remember this because many of you weren't alive, but the big concern was that ATMs and largely the entire technological society we had was going to collapse when the year turned 2000 because computers weren't going to know it was the year 2000. That computers were programmed to just recognize the number, the last two digits of the year. And so when it was 1999, the next year was going to be 00. But if computers thought that it was the year 1900 and not the year 2000, then things like ATMs, the banking structure, things would collapse. So, in the lead up to the year 2000, the Federal Reserve put a lot of money in the economy. There was a lot of cash there just to kind of avoid any problems from emerging. And then in early 2000, after we realized that there were no problems, um, interest rates started to rise. And some of the cash was withdrawn from the economy, so the money supply was reduced. And so interest rates rose in 2000, and as those interest rates went up, then the dot com bubble burst, and we entered a recession. And the other thing that happened is that there started to be a true questioning of the numbers being released. So the best example would be Enron. I kind of remember Global Crossing. Dude, I know Kmart was pretty big in Hawaii, but um, I don't really want to talk about Kmart here. Enron was the big thing. Um, and there's a pretty good documentary called The Smartest Guys in the Room where you could kind of learn more about Enron. But Enron basically was an energy trading company. They didn't actually make the electric, they traded the electric. And to make money, they kind of created fictitious values for it. At one point, Enron was one of the most highly valued companies in the world, and it basically was built on accounting fraud. Accounting that was the accounting scandal, and then the economy, and then that company collapsed and went bankrupt. Um, which is, I guess, kind of part of the point of the slide here, is that a company that keeps losing money, eventually at some point it may not be able to borrow money anymore, and it enters bankruptcy, where it's basically a legal declaration that it cannot pay its debts and that it needs to be reorganized. Um, let's see, big bankruptcies. COVID, you would think that it would have caused a lot of bankruptcies, but it didn't, largely because there were bailouts. Probably the highest status bankruptcy we saw during COVID was, I don't know, Hertz, the rental company, declared bankruptcy. Almost every airline declared bankruptcy after September 11th, with the exception of Southwest Airlines. Um, just trying to think here. Largely Sears and Kmart have are largely non-existent. Um, trying to think of others that are um, either bankrupt or pretty darn close to bankruptcy. Um, I feel like I need to think of at least one more. Well, the big one, I guess, which isn't an American company, but that should be fine. Um, um, the Evergrande, it's a Chinese company and real estate company, and it's pretty darn close to bankruptcy for every intent and purpose. Just doesn't have any cash. The Chinese government tried to bail it out, but as you can kind of see here with how long ago most of these things are being released, it's probably going to go bankrupt here in just a few days. Um, and that would be pretty bad. That would be a pretty big failure for the Chinese economy. You don't need to. I mean, if you're really interested in the Enron case, I'm not going to be able to explain it that quickly. Well, let's just see here if we can kind of take a clip from the movie Smartest Guys in the Room. Yeah, I understand I just spelled it wrong. And let's just watch the trailer. That's always a good way to do it.
My car is dented. Geico does offer 24/7 claim service. 24/7? That's a lot of attention. They're not actually with you 24/7. They're just available whenever you need them. Okay, because I'm an introvert. It's incredibly rare. I don't think that's right. Geico. It had taken Enron 16 years to go from about 10 billion of assets to 65 billion of assets. It took them 24 days to go bankrupt.
The fatal flaw at Enron was pride, arrogance, intolerance.
Why you guys stole from those poor grandmothers?
We can add $1 gazillion to the bottom line.
All right, that sounds fantastic.
Did you convert stock worth $66 million?
I don't know. I netted approximately $100 million.
Enron is a company that deals with everyone with absolute integrity.
Talking about my compensation, if I step on somebody's throat on the way, that doubles it. Well, I'll stomp on the guy's throat.
The other thing about people at Enron is a lot of them were former nerds. You wanted to be the most popular guy on Wall Street, and you were going to do whatever you had to do.
They sought out every loophole they could in order to profit.
The rules weren't quite clear. They could bury debt, they could bury losses.
An industry that was very reliable for 100 years was all of a sudden turned into a casino.
Those guys could just yank the California economy on its leash whenever they wanted to, and they did it, and they did it, and they did it.
There's deals away from California to the tune of $1 million or two a day. Could I predict phony energy crisis as a result of deregulation? Yes. Could I predict that Arnold Schwarzenegger would be a governor as a result of deregulation? Oh, I didn't expect that. How exactly does Enron make its money?
Accounting doesn't get that creative.
I would like to know if you are on crack.
This is the shredded evidence that came out of Enron.
Everyone was on the bandwagon, and it can happen again.
We are the good guys. We were on the side of angels.
It has evolved to the corporate crime of the century.
Okay, so I think this movie is on. I think it's on Netflix right now. If it's not on Netflix, I think it's on Amazon Prime, where you could actually watch it for free if you're so interested in learning more about Enron. Or I guess you could watch this 19-minute video here. But basically, again, it was accounting fraud that led to everyone no longer being able to trust the numbers coming out of the company. And again, you see the stock market crash in 2008, 2009, which generally gets us to increases all the way up to COVID. In COVID, you see this rapid decline in March of 2020, but then it quickly recovers within just a few days, largely thanks to a bailout by the Federal Reserve to pump money into the economy.